Hello everyone, and welcome to Nordics IBOR Transition webinar. Hope all of you have had a great summer and enjoyed time with family and friends, even though it's been a different summer holiday this year. Thank you very much for taking the time to attend. We hope that you during the next hour are able to learn something that you did not already know. We will give you the recent updates within IBOR Transition with a Nordic focus. And our aim for today is to give you an overview of the practical challenges in relation to IBOR transition. If you go to the next slide. My name is Arbab Dar, and I am an associate partner with EY and head of CFO advisor services for the Nordics. And I'm also IBOR transition lead. I will lead you through this short webinar together with Chiara and Jan. Chiara is a manager working within consulting. She's also IBOR transition lead for Denmark. And Jan Rosam is with us. He's a partner with technology consulting in EY Germany and also IBOR transition lead for Germany. If we go to the next slide and have a look at the agenda, we will start with a short introduction and background and then move over to status and outlook for IBORs globally, but with a Nordic focus. Then we will share insights, experiences, and practical challenges based on our experience in leading IBOR transition programs with financial institutions. Before we continue, I will just give you some practical information. We have 160 participants today, represented from all sectors within financial services, but also representation from non-FS. All microphones will be muted during the webinar. This means that you cannot ask questions by using your microphone, but you will be able to ask questions in the Q&A box that you see next to your slides. I encourage you to type your questions during the session, and we will try to answer these towards the end of the webinar. And the slides will be shared to all participants after the webinar. So if you go to the next slide, let's do a quick recap of IBOR transition. The first agenda item is to give you some background and to set the scene, even though most of you already are aware of this. IBORs are, as most of you already know, interbank offered rates such as LIBOR, Euribor, NIBOR, STIBOR, and CIBOR, and so on. These rates are common and used in many financial products, and IBORs are estimated to impact over $370 trillion notional value of financial instruments across the globe. Many of you maybe remember the series of scandals around LIBOR fixing, and a number of banks were fined for this as well. And this is definitely one of the drivers for change, as there are panel banks involved in setting the rates. And one other thing is that if you talk to the regulators, they are worried about that these rates are not transaction-based. So the regulators are very keen to move to new reference rates or alternative reference rates, which are set on actual transactions. So all this focus has resulted in a global focus on IBORs and work related to finding suitable alternative reference rates. This work was kind of initiated some years back. And what we see now is that the alternative reference rates that are currently being introduced are generally overnight rates rather than term rates. And in some markets, these rates are secured, and in some markets, they are unsecured. The IBOR reform with the new alternative reference rates that are being introduced will definitely have a huge impact on financial institutions and all financial contracts that are linked to an IBOR, and it has to be looked at from various angles. Jan will come back to this later in the presentation, but the work with the alternative reference rate in the Nordics kind of is not finalized yet. This is kind of work in progress, and discussions are ongoing in the different working groups that have been established. And Chiara will give you more details about the status in the working groups. But as most of you know, it has been communicated that LIBOR will likely cease to exist end of 2021. Financial institutions now have approximately 1.5 years to understand the impact and start the transition. And we, of course, have a lot of conversations with banks in the Nordics. And the feedback we are getting differs naturally based on the exposure they have towards different IBORs. And what we see is that typically larger banks in the Nordic market have carried out impact assessment and started and established a project to start the work with the transition. Whereas the mid-size or smaller banks have more a wait-and-see approach. We believe that some of the initiatives that have been started in the Nordics has also been started because has been triggered by that some of the financial institutions have received a letter from the local FSAs where there have been asked questions to assess the readiness of moving to alternative reference rates. And it is fair to say that the focus from the regulators definitely will increase going forward. And this is especially from a financial stability focus. With this, I hand over to Chiara to talk about the global and Nordic status and outlook.
Thank you very much, Arbab. I think I'll give a brief recap of the status of this transition away from IBORs, both at the global level, and then we'll zoom in into the Nordic level and see what happens in the Nordics. So if we move into the next slide, please. Then let's start by looking at LIBOR. Arbab mentioned before how LIBOR is expected to cease to exist very soon. And we know that the UK authorities have been very explicit over time, saying that they will not guarantee LIBOR after end of 2021. So days left for LIBOR are counted by now. So we've seen over the last couple of years a lot of work and a lot of focus on creating alternative reference rates to substitute LIBOR. So when we look, for example, at the pound denominated market, we've seen a new rate called reformed SONIA being created. In the US dollar denominated market, we've seen SOFR, and then in other jurisdictions, we've seen similar work to create alternative reference rates to substitute LIBOR in the respective currencies. Now, if we look into these new alternative reference rates, the common denominator there, just like Arbab mentioned before, is that they're all short-term rates and they're all transaction-based. This is to compare to LIBOR. As we know, LIBOR is a term rate, so typically you have contracts referring 3 months or 6 months LIBOR, for example. And we know that originally LIBOR was set based on quotes from a number of panel banks. So this is something to keep in mind, because when we look into transitioning away from LIBOR and into these alternative reference rates, a lot of work needs to be done to make sure that contracts referencing LIBOR, for example, 3 months LIBOR, a term rate in LIBOR, have an appropriate fallback to ensure a smooth transition toward these alternative reference rates. So a lot of work and a lot of focus right now is around how to construct term rates based on the alternative reference rates. Now, if we move away from the global level and we zoom into the Eurozone, here it's important to remember that there's another player in this LIBOR transition topic. This player is the European benchmarking regulation, a regulation that indeed covers a number of benchmarks, so not only interest rate benchmarks, it's a more broader regulation, and it sets a number of requirements on the administrators, the users, the methodology, and the governance around all of these benchmarks. I won't go into details on that, but I wanted to mention that because when we look at Euribor, then Euribor was originally redeemed not to be benchmarking regulation compliant, and therefore we know that over the past year there's been work around reforming the methodology to construct Euribor. So we now have a reformed Euribor which is more transaction based. But that also means that Euribor can, from a purely regulatory perspective, survive in the future. So the crucial question, and what we'll likely be seeing going ahead, a few years ahead, is that the transition away from Euribor will probably be a market-driven transition more than a regulatory-driven transition. And indeed, we're already seeing today the liquidity in transaction space in Euribor is quite low. I believe Jan will come back to that later. Now, if we look at the other euro-denominated benchmark, Ionia, then Ionia was also redeemed not to be benchmark regulation compliant, and it was decided not to reform Ionia, but instead phase it out over a couple of years and introduce instead a new alternative reference rate called Ester. I'm sure you're all familiar with Ester. It has been published since October last year, and the market has very slowly been started to adopt Ester. More recently, we've seen clearinghouses, for example, switching from Ionia discounting to Ester discounting. So this is happening, and Ester is very slowly being started to be used in the market. Now, if we look into the Nordic IBOR, so we can go ahead one slide. Then the situation in the Nordics is actually mirrors a little bit the situation in the euro-denominated market, because on one side we have the Nordic IBORs, and then on the other side we have the work in order to establish alternative reference rates based on the Nordic currencies. So if we look at the Nordic IBORs, STIBOR, NIBOR, and CIBOR, then they're also all been reformed in some way or shape. For example, some have changed administrator in order to be adopted to the requirements of the benchmarking regulation. So the aim there with those reforms was to make sure that indeed all of these Nordic IBORs can be benchmarking regulation compliant, and therefore can in principle also be used in the future. At the same time, just like in Europe, we've seen Ester, we've seen work in the Nordics with working groups being established across the countries in order to establish alternative reference rates in the respective currencies. So these working groups have been working over the last couple of years. I think when we look at Norway, they're a little bit farther ahead in their work than they are in Sweden and in Denmark, as the reformed NOVA, the alternative reference rate in the Norwegian currency, is actually already been published, and it has been published since January this year. So that is already in production, you can say, here in the market, while in Sweden and in Denmark, the alternative reference rates that have been recommended from the working group there are not out in the market, are not in production yet. In Denmark, we're in a testing phase, so the rate is calculated and it's published in Finance Denmark homepage, I believe monthly, in order to follow the development of the rate over time. So it's a testing phase, but a production, like the rate is still not in production yet. So that is the next step that is expected in Sweden and in Denmark. Apart from that, I think the working group are still working across countries. Focus is making sure that the rates will be adopted and to ensure a smooth adoption across the market. Also, other focus area is very much on the term rates, making sure that legacy contracts can be converted and can have a good fallback language. I think with that, I will conclude this very, very brief recap, and I'll give the word to Jan.
Sure. Thank you very much, Chiara, and also a warm welcome from my side. My name is Rosam. I'm a partner in our German consulting practice here in Frankfurt, and yeah, so I'm representing EY not only at the ECB working group, but I'm also leading our IBOR transition campaign here in Germany, where we support many clients on the buy and sell side on the IBOR transition, as well as the implementation of the benchmark regulation. And in that context, I'm also sitting in 5 steering groups, and therefore I'm very close to our clients and that topic and our projects. And so the idea is really to share my insights with you today in the next half an hour on where are the European institutions at the moment, what are the challenges, what activities are left for this year and what will come next year. So, and then hopefully to end up in a lively Q&A discussion with you. So if we go to the first slide, and I think it's just a recap on what has been said already by Chiara and Arbab. So I mean, from a European perspective, of course, that was a big relief when Euribor became benchmark compliant, because you can imagine it would have been a big undertaking to replace Euribor, and the reason really is that Euribor in the Eurozone has been or is used for consumer products a lot, and much more than US dollar LIBOR or sterling LIBOR. So therefore, there was a big interest also from regulators in the European Commission to support the market in making Euribor compliant. So therefore, from that perspective, what the transition is really about is transitioning away from LIBOR, because most of the European institutions, of course, have subsidiaries and branches in New York, London, in Asia. So therefore, there is still a substantial LIBOR exposure in these branches, and therefore that's the key point in the transition. On top of the EONIA transition, as you can imagine. So I think the point is, so we're not talking about IBOR transition in the future anymore. So because transition has started, and I think the starting point of the transition, as you know, was the publication of all the new alternative reference rate. And as we learned, except from maybe Denmark and Sweden, I mean, most of the alternative reference rates have been published by these days and have already started to gain liquidity. And the major key milestone was end of July this year, when the large clearinghouses switched their discounting regimes from EONIA to ESTR, which of course was a big thing, and we supported a lot of banks, and it was also a big hassle. I mean, we've seen updates on thousands and thousands of derivatives, so that was a big thing, and the hope, of course, is now that we see liquidity increase in ESTR to support the legacy transition, which is something which will come next year. So therefore, I think this year activities we see, and I come back to this in the next slide, is first of all, of course, to make sure that the new products are set up. So, and when we talk about new products, people ask me, okay, what do you mean with new products? I mean, a loan is a loan. But I think what is really important and what has been underestimated heavily by the market is what Arbab was saying, that these new alternative reference rates and the way how we will deal with this in the future will be totally different, because we will have an overnight rate which is in arrears compounded. So, I mean, that's something we know from the derivative markets. I mean, we have been trading these type of products for a long time, but we have not and never seen this before on the cash market. So that means on floaters, securities, and loans. So, and when I talk to people from the credit on the loan side, like, okay, we have like in arrears fixed loans, they was just laughing at me and say this will never happen, but it will happen. And I think that is important. So therefore, it's really important to make sure that these new products are set up in your systems, and there are a lot of vendors working on solutions, and some have come very far, some have not yet. But I think that has been the main focus, as well as the discounting switch. And the next date, which is important, is the switch of the US dollar denominated cleared derivatives, which will happen in October. So the question is really what's to come. So I think this year, as I said, the focus was really on making sure you have a good understanding of your exposures, because I mean, Chiara gave just a snapshot of indices and benchmarks which will be affected. And of course, there will be much more. We have Swiss LIBOR, Japanese LIBORs. We have a lot of other reference rates in Australia, in Canada, which will undergo certain reforms. So therefore, it's really important to understand where your exposure is and the different product classes. I think that was a focus this year, also to understand the impact on the contracts. And I will share more details on that later on, and to introduce these new products, because as you know, COVID-19 has not changed the timeline. So FCA, of course, and the UK regulators, they appreciated and recognized the circumstances, and supported the market a little bit by pushing certain timelines from 2020 to 21. But basically, they clearly communicated, and all regulators clearly communicated, they will stick to the end of 2021 timeline. So therefore, there's no relief. It's no time to relax. It's really to focus on the actual transition, because next year will be on the legacy transition. And the legacy transition is difficult depending on product class and contract type. So, but I will come back to this in the next slide. So therefore, maybe to move on to the next slide. And so what are the focus areas of our clients we're supporting, and what do we see in the market? And we can cluster this into 4 areas. So the first area is the introduction of new products. I think this is an activity which will continue into next year. And the reason for that is we do not have market standards yet on the calculation methodology. So because in arrears compounding can be done in different ways, there are different methodologies. There are things like averaging, look back periods, and stuff like that. So it's really a question on how do you actually calculate this in arrears compounding rate. And there are different approaches to this topic, but at the end of the day, it will boil down to what the market really wants and what the market will adopt, and where the market standard will lead to. So therefore, since we do not have this market standards, there is a lot of effort needed to implement potentially much more methodologies and calculation methods than you potentially need in the future. And that will also change going forward, because as Chiara was mentioning, a forward-looking term structure will, if ever, be built end of next year. So therefore, there's more to come on market standardization, calculation methodology, as well as term structure. So therefore, the introduction of these new products will not finish this year. It will continue into next year. So the second area is really around legal contract analysis and repapering. So, and the repapering has started. So, and there are two areas of repapering, and Chiara mentioned it. It's first of all to make sure that you have fallback implemented. So, which is something which came out of the benchmark regulation, and for those institutions in the call who are regulated by the European framework, then of course you need to comply with the BMR regulation. And the BMR regulation clearly says that if you use a benchmark, then you need to make sure that you have a robust fallback implemented in your legal contracts, and that is something which will happen. And the second part of the repapering is the agreement on compensation. And where does the compensation come from? And I think we come back to this, is when you change a discounting or when you change a reference rate, this will potentially, or it will lead through a compensation payment to what we call a value transfer. So it's not like that you just change your reference rate and everything is fine. No, it will have an impact on your valuation. And when it has an impact on your valuation, you need to ask the question, how do you compensate each other for this? Or how do you adjust the terms? And that term adjustment, that adjustment of or agreement on compensation is of course also part of the repapering, which has already started in the market now when it comes to the bilateral derivatives and the renegotiation of the credit support annexes, so the CSA agreements, as well as the local collateral agreements. And that was something which started when the clearinghouses switched end of July. So the third area is really around the preparation of the RR transition. So what we mean is, so we call this a backbook transition. So it's a transition of your legacy portfolio, of your legacy products, which will go beyond 2021. Because it's also clear that, and I think regulators have been clear on that, and your legal department will be clear on that, waiting until the fallback kicks in is not an option. It's a safety net which has been generated, and it might be used for certain what we call tough legacy. So basically contracts which will be very challenging and difficult to change over the next year. But fallback is not the mechanism for the backbook transition. It is really to bilaterally discuss and negotiate with your counterparty on the terms and conditions for the transition, because otherwise you potentially have economic impact on your legacy portfolio. And I think that is really important. So therefore you need to prepare for this. And the transition will be different depending on the product types. So I mean, of course, you cannot transition an issued primary market security in the same way as you change the reference rate on a derivative or on a loan. So really depending on the type of contract and the product type, the transition will be different and need to be analyzed. Do you close down your position and reopen a new one? Do you modify your products? How does it work for the different product types? So that is something which you need to investigate and you need to prepare for. And the fourth area, which is really important, and this is something which also Ernst & Young is working on, and is really communication. So I'm representing EY in the subgroup 7 at the ECB working group, which is concerning the client reach out. And that's, of course, very important. It's very important to educate your clients. It's very important to educate your counterparties, to get in contact with them, to discuss with them on timelines and processes going forward, and to inform your client base. And that, of course, has been on the topic also when we talk around conduct risk. For those people who are really into the topic, they will know that there's been a lot of noise on conduct risk. Do I need the specific frameworks for conduct risk? That is something which depends on the market. There is, of course, it's a very UK-driven topic, but it's very important that you analyze this for your client base. And of course, if you have retail clients which are impacted, then as you can imagine, the customer protection rules, also your local ones, are much stricter than when we talk about wholesale market and professional counterparties. But nonetheless, communication is key, because as I mentioned, your transition, the transition away from those products you have in your portfolio, is a bilateral negotiation. So that also means you need to train, you need to educate your internal people. All client-facing people need to be educated, because they will face a lot of questions from clients. So therefore, it's not only external communication, also internal communication. so that everyone knows what will happen next year, because it will have a major impact also on your line organization. It's not just a project topic, because even if you have a project which has been set up, client communication, client negotiation is something which these sales and client relationship managers need to do. So you need to train them. So, but let's dive a little bit deeper into these areas. Let's start with the introduction of new RFR or ARR products. So if we go to the next slide, you will see there are basically the products, or you can cluster them in four groups. So first of all, you have all your, let's say, account products. So saving accounts, debit accounts, current accounts, standing accounts, whatever you want to call it. So of course, we see that specifically in the wholesale market, a lot of these account products are have an interest on Eonia, for example, or we have Sonia and others. They need to transition away. So I think that is something a lot of people have been working on, specifically now when ESTER was introduced in 2019. So we see the first transitions happening here, that people change the accounts. But there's also, specifically when it comes to debit and saving accounts, there's been a discussion on the strategy. So because it's a question on, do you really want to transition these accounts from Eonia to ESTER, or do you want to transition maybe from Eonia to Euribor? Because then Euribor, you know, it's compliant under the benchmark regulation, and maybe that is also a sustainable solution. So therefore, it's not obvious, and it's not always necessary to transition to another overnight rate. Maybe it, for example, on the account side, maybe it makes sense to use Euribor. And the reason for that is, that's maybe some really insights here. So of course, when you have a communication with a counterparty, then and that counterparty, as you can imagine, is not so much in the topic as maybe we do here on the call, and you need to explain to them, you need to switch from Eonia to ESTER plus 8.5 basis points. Then of course, if you are a client, then it's like, okay, wait a minute, why do you charge me additionally 8.5% margin? Of course, it's not the margin, it's just to compensate, and it's to level out Eonia against ESTER. But as you can imagine, that's a discussion you need to have and you need to take. So therefore, some clients or some banks are saying, or maybe that's a discussion I don't want to have. So therefore, maybe it's easier to transition to Euribor. So, but anyhow, that's something you need to look into. And of course, you need to prepare your systems for to be ready, specifically when it comes to account statements and the way how you actually calculate on, let's say, year end, month end, quarter end. You know, that's also something the auditors will look into. Do you send out the account statement of the last day of the month, knowing that ESTER has not been fixed yet because it's published T+1? So do you send out the account statement a day later, 2 days later? Do you anticipate stuff? So therefore, there's been practical questions, not really exciting questions, but practical questions around account statement and how do you send these out, given that the new reference rates are fixed T+1. So the second area, which I find is a very interesting, is around securities. So we, as Chiara mentioned, we already have liquidity in certain products and certain reference rates in the US, and the Sonia floaters are published frequently or issued frequently. So, but it's really important to understand it's a fundamental new thing for floaters. We have never seen Eonia floaters before. It's a product which has not been used. So therefore, introducing floaters on these new reference rate is something really new. And specifically when you have like a custody business, or when you do like securities back office services for counterparties, or do it on your own, then at the moment you're used to consume the coupon information for floaters from your provider, let's say Bloomberg, or in Germany we have WM data services. But those type of data services will not publish the next coupon anymore in their reference data. So that means in your securities systems you need to calculate these in arrears fixed compounding reference rates. And so that is something which we have seen is something new and requires adoption of IT system and a lot of discussion with vendors. But of course, if you go to the buy side, there are also discussions around when do you switch from LIBOR or LIBOR used secures into new ones, and but that I can come back a little bit later on. So derivatives is relatively straightforward, specifically when we talk about interest rate swaps in general. But there are certain things which you need to be aware of. So first of all, we have never seen, for example, caps and floors on these type of reference rate before. EONIA cap has never been traded, as I think. But the thing is that you need these type of options when you issue a security. So let's say you want to issue an ESTER bond going forward, then of course we have negative interest rate environment, so therefore you need to floor it at 0. So that means you need to have caps and floors on ESTER. Of course, it's a new product, needs to be introduced, and there are a lot of things on the specific on derivatives around market data. Of course, you can imagine, and I don't know, I hope Bloomberg and Reuters are not in the call to make comments on that, but I mean, this is also a substantial amount of money they are charging you. So of course, they are repackaging at the moment their market data services, and there will be charges on that for these new reference rate. And of course, you need volatility services, you need swap rates, etc. So keep in mind to if you want to issue securities, you need options on the derivative side, and a lot of market data issues arise. On derivatives, there's a discussion on swaptions. I can maybe comment later a little bit on that. So, and what's also important is that specifically if you work in a larger institution, then in order to control and to hedge your market and liquidity risk on the treasury side, then of course you use derivatives. So that means when we come back to the next one, if you want to issue loans, and it's not like if you want to, you need to loans in these new products, then of course you need to think about how do you split the risk out of the loan book. And that is usually done by basically feeding back these loan cash flows into your derivative system and splitting the risks into usually into liquidity and market risk by splitting it into a bond into a swap. So that means when we talk about swaps, we're not just talking about overnight index swaps. You also need to be aware that you introduce all the calculation methodology you are using on the loan side and the security side, also on the derivative side. So therefore, most of the well-known vendors around derivative front and back office systems are working on that. Keep in mind there will be releases coming up. You also need to make sure that your treasury works when you introduce these new products. So therefore, derivative side is also something where we see efforts around this, even the fact that we have seen those type of products before. And then loans is a mess, I can tell you. So I mean, to introduce loans on an in arrears compounding overnight rate, it's difficult. And of course it depends on what type of loan products you have in your portfolio and your trading, but it is not easy. So, and of course, if you can imagine that you need to daily fix your loan book, I mean, if I tell this people like this again, you're crazy. This will never happen. How should that work? So, and of course, if you have fair value loans in your books on IFRS, you have hedge accounting topics. You need to introduce multiple calculation methodologies depending on the market you are in, depending on the product you're using, depending on what your syndicating partners are using. So therefore, it's a lot of effort. And you can imagine if you change something in your loan system, then you need to test everything front to back, from capturing loans down to your regulatory reporting, risk, finance, functionality. And that is a big effort. And keep in mind, FCA is saying you need to be done by end of Q1 2021. So because they want you to issue loans in those markets only on the new RFRs after Q1 2021. So that means if you haven't started yet, it's August. So you need to be done in March. You can imagine it's a tough undertaking. So, but let's move on to the next area, which is allowed legal contracts repapering. So, and what we did here is basically we clustered the type of documentation based on the products we have shown you before then. So accounts, specifically when you when you look into retail, it's governed under the general terms and conditions. We have not seen huge changes. There have been some discussions around that. Do you need to change it or not? And then also in which way. So that depends on your local regulations. Nothing I can advise on here what needs to be changed. But we see both. So bilateral amendment agreements going out, but also from the retail side to use general terms and conditions to change that. But so interest on accounts for retail is at least what we are seeing here in the let's say German-speaking market. It's rare. It's there, but a lot of banks decided, as I said earlier, to focus more on business transformation and move those accounts out into Euribor just to avoid discussions with clients and specifically retail clients around this. So the second area were around securities. So of course there is a prospectus change needed, and so from a legal perspective, it's not obvious. How do you do this? So I mean there are certain ways. So basically you can use like an investor conference, so which is probably not practical. You can buy back your issuance and then issue a new one, not practical. So therefore it requires one-sided changes to the security prospectus, which in some cases the issuer needs to undertake, in some cases the agent. It really depends on the type of security. So, but this is tough, and I think that is something we have seen the first prospectus changes in the UK. We're working on some in the German market. I'm aware of at least, and I think that is something you really need to focus on. If you have large issues out there, so then it's something which is really important to have a look at. So derivative master agreements is a big area. Of course, as I said earlier, around derivatives. So we have two initiatives ongoing. So first of all is the repapering of the collateral agreements with CSAs, and in German market, and I know also in the Nordic market you have local master agreements. So therefore there are changes expected. We have certain protocol solutions from ISTA. So we had the BMR protocol, which came out end of last year, and we have also now upcoming the IBOR fallback protocol, which will be issued potentially as we speak. There is a certain period of adoption, so therefore they will go live in Q3, or let's say now beyond Q3 in Q4 this year. You have also seen a lot of media coverage around this. So the ECB working group reached out to a lot of banks on saying, please adhere to the protocol. ISTA themselves reached out. The ARC working group reached out, and I think that is something, a continuous effort we will see. So therefore, it's really important that you have a look at the IBOR fallback protocol and also to understand the implication, because it is not something you just adhere and things and problems go away. So it's important also to understand the implications on your portfolio, and there could be valuation implications. So therefore, you really need to look into detail. So other than that, mainly on the collateral side, the negotiation, as I said, have started, and it's done in a bilateral basis. So therefore, there are amendment agreements which are currently exchanged. The big counterparties have already started also to negotiate and compensate each other for their portfolios, and that will cascade down to buy side. And I think that's a continuous effort until end of next year. So, and then of course we have the loan agreements. There, it's a wide range. It's nothing. It's nothing we can cover here full in this talk. So, of course, you have on the one hand side you have your LMA agreements, which are kind of standardized. There is fallback language which has been published. But our experience is specifically from European perspective. If you trade in the US or in the let's say or in Asia, then you usually use lawyers and law firms to help you with your legal negotiation and contract papering. So therefore, even if there's a standard, it doesn't mean that the lawyers will apply the standard. So there will be variations around that. So then, of course, you have your bilateral loans where you have it in your hand to include fallbacks into it, and also to think about how to change these legal agreements. And then you have syndicated scenarios where you could be the lead in the syndication, or where you could be just participate in the syndication. So and therefore there could be different solutions on the way how these contracts are dealt with and how it's negotiated and how things work. Important is the last point is really specifically on LIBOR. We talk about foreign currencies, and let's say we talk about legal contracts in foreign jurisdictions. So therefore include and be aware of costs which will be occurred in this negotiation. So conscious of time, let's move to the next focus area. It's around the preparation of the transition. As I said, for the cleared business, transition has started. I guess if you are a member or if you are a client using LCH and Eurex, you will have been part of the transition already in July. Next is it's in October. It's a little bit different the way how compensation works, and I think. So the difference is really that Eonia and ISTA are linked to each other. It has been chosen in a way that it's basically the risk is going in parallel. But now when you change from Fed Fund to SOFR, those two rates are not linked to each other. There is, of course, certain correlation, but it's not fully correlated. And if you look at recent behaviors for both rates, then you will see there's actually not much correlation. So therefore, there will be kind of risk compensate or risk swaps booked into your portfolio to compensate for this basis risk you will buying in when you change from Fed Fund to SOFR. But other than that, I think it has been proven to go very smoothly. We have not seen huge hiccups in the market. So therefore, I think the market should be prepared for that. So the bilateral business, as I said earlier, transition is starting now on the derivative side. We will see activities on the loan side. The clients we are working with is really that everyone wants to be prepared to start the bilateral discussions, let's say in Q2 next year. What I'm a little bit surprised of when I heard this the first time is that because the clearinghouses also need to change the reference rate of the product, because the changes today are just on the discounting curve. So, and the recent announcements I've seen is that the clearinghouse will go very late. So in the second half of next year, they will change the reference rates. So therefore, there are different timelines, and I think banks cannot wait for that. It's important to know that, because when you at the moment, if you have like an Eonia swap, then the Eonia swap usually only fixes annually. So therefore, if you want to change this product on the coupon pay date, then it's just one date left. So we cannot wait, and that date could be March next year, that could be April, that could be January, could be November. So therefore, I think it's really important that you build a plan now how you want this transition to happen. And also it is combined with your communication strategy. As I mentioned earlier, it's really important to have bilateral discussions. So then the cash product transition, it's as I said, on the loan side, that will start soon. We have seen that the first counterparties reached out and wanted to understand how the transition will work, what the timelines are. So prepare for communication, prepare for issuing the first products very soon. We have seen in the Swiss market a lively market. Also on the loan side, things are coming up. And on the securities, the advice I can give you, it's a long process. Start early, understand where you have your exposures, and start early the conversation with the agents. And I think that's something which is really important, because also from a buy-side perspective, and we are advising a couple of very large buy-side firms, they will also start switching. Not this year, I think it will start next year. Because they need to get out of their LIBOR exposures. So focus area 4, and I think maybe I keep this a little bit short. I said it earlier. If we go on the next slide, it's really about communication and conduct risk. So I think that's it's important. But I spent a couple of minutes on that already at the beginning, so I will skip this. If there are specific questions, then of course we can do this after the meeting. Maybe 2 or 3 points to mention. I think most of so there is a discussion ongoing in the market whether you should reach out to all of your clients to inform that. Most of the clients we are working with decide against it. They are more decided on setting up websites and informing those counterparties who really have exposures in that in these reference rates. So, but it's really important that you train internally, because what we see now is banks get flooded with requests from clients, and the request reaches from, can you tell me what this thing is all about, to really detailed questions like, when do we change my product here? How does it happen? What happens here and there? So prepare for this, for these client reach out. And this is also the case for buy-side firms. You have also investors you need to inform with. You will have changes to your documentation. So also there on the buy side, it's important to keep communication on the agenda. And this is a focus area for regulators. And I think Arbab, and I think we mentioned this on one of the slides, is there was regulatory push. We still expect, and I cannot confirm on that, sorry, but I still expect that ECB will reach out this year, because if they don't do it this year, I think next year is too late. So therefore, please expect that the ECB will come out with something this year to understand and push the market a little bit and to, let's say, re-energize the market and prepare for 2021. So to conclude this, and I think I'm running over my time a little bit, so that we have at least 2 or 3 minutes time. So what are the lessons learned? So first one is know your exposure, know the impact product, know your clients who will be impacted and the contracts. Don't underestimate the time and effort needed for the introduction of new products. It's a wide range of products. You need to go through your new product approval process. Your auditor will have a look at this. Please be aware, I think IBOR transition will be on the agenda for the year-end audit and stuff like that. Of course, that new product approval process is something guys like people from the auditors from EY like to have a look at it. It's also connected to changes in risk models and valuation. So that's always something people are looking into. So there's still no final market standard for existing for the interest rate calculation methodology. So therefore, be aware that you will produce sunk costs. So you need to maybe introduce more calculation methodology that you might use at the end. So there will be there are vendors which are still working on releases and releasing software packages and updates, upgrades. So keep in mind that things to come also next year, which is important for your planning. And then the last thing is really that central governance and senior management attention is needed, and we see this all the time. And I think that's also requested by the ECB. ECB wants to see that you take this seriously and avoid market disruption. And that is only possible if you have a clear and centralized and senior management governance around this, because the ECB will talk to the board members and to the supervisory boards, and so they need to also to be kept informed on that. And I see a lot of board members interested in getting closer to these projects because they will face questions in their GSTs. So what is the outlook? And just a few points here to mention. Maybe it's also a little bit of a personal touch on that. So next year is really important because you need to fully align your organization. So if you have a project governance, that's fine, it's good. Maybe you use external consultants, hopefully use us. But the thing is that the bilateral negotiation need to be done by your own organization, by your own people, by your own client-facing stuff. So therefore, keep in mind that the internal resources you will need next year will be much, much greater than this year. And that needs to align with your other initiatives. So you maybe have conflicts in other initiatives. So this is really important. But the next thing is that the IBOR transition is potentially not over in the end of 2021. So we have seen current announcements in Singapore, so where the SIBOR will cease to exist in 2024. And that's also the case around third country benchmarks. So therefore, my expectation is there will be project extension of these initiatives next year. And it will continue. And I think that brings us to the third point, and that is a personal point. It's not EY view. It's really, I doubt that Euribor will exist for a very long time. And the reason is why Chiara said earlier, if you look at the methodology which has been implemented for Euribor, and if you look at the percentage where actual real market transactions are used for fixing the Euribor, it's 10%. Imagine, it's still 90% is panel contribution. If someone wants to explain to me this is a robust and a much better rate than we had before, then I doubt this, and the market will doubt this as well. So therefore, it's important that the ECB working group is working on fallbacks for Euribor, and I think we will see in the next years. So when we are done with LIBOR, let's say for an EONIA transition, we will see discussions around Euribor, and I think it's really important. And the last point I want to mention is be aware there are current legal enforcement out there. There is current European Commission will change the BMR regulation. There's a current discussion ongoing. It's still in consultation, but it's kind of finalizing. So there will be changes to the BMR, potentially allowing the European Commission to nominate a fallback reference rate for existing LIBORs or EONIA, which will hopefully give some clarity on the legal side. But it's nothing to rely on. So you cannot wait until this kicks in, because it will potentially have economic impacts on your portfolio. So therefore, it's another safety net which they will implement, but it's not a solution for the transition. So having said that, I close my session, and I appreciate you stay with me. I exceeded my time by 5 minutes, and get back to Arbab.
Thank you, Jan, and both Jan and Chiara for sharing your insights. We don't have that much time left for questions, but I still encourage you to type your questions, if any, and we will reach out to you directly and answer your questions. But still, I want to ask one question to you, Jan, and that's kind of related to if financial institutions have not started their IBOR transition work, is it too late? Or how would you suggest that one should get started, if not started already?
Well, it's never too late, and I think it's really important to start now. So, I mean, we developed a rapid assessment framework where we can assess the potential impact in a very short period of time. It's not this huge undertaking. So, what is really important is that you need time for system adoption, and of course, I can assure you here, a lot of banks are working on tactical workarounds because they will not get this fixed by 2021. So therefore, I mean, even if you are running late, you should start now. It's important topic. It has effect, and hopefully I could. You have the impression after our call now, it has not only effect on front office and back office, also on legal, risk and finance. So therefore, it's never too late, but you need to start now. And imagine now it's August, we're heading towards Christmas time, and then it's year-end process. So time is running now, and it's not, as you mentioned earlier, 1.5 year left. It's much less time left, and the regulators are pushing. So therefore, do not expect an extension of the timeline.
Thank you very much, Jan. We have included some publications on the next slide. We encourage you to read them, and we also encourage you to reach out to us if you have any questions. We thank you very much for participating and for your questions. As mentioned, we will get back to you on the ones that we have not been able to answer during this session. We wish you a nice day, and please take care. Thank you very much.